Hello, and thank you for joining us here. Today's lecture, we're going to be going through international business, also known as the global context of business. And many students have a difficult time thinking of the application for international business, and I can definitely understand why. But hopefully after the course of this lecture, you begin to understand really how intertwined we are. And the very products that you use every day, from the computer that you're probably using to listen to this lecture, to your smartphone, to tablet computers, your vehicles, a lot of the components were not created in the United States. Those components were created in various parts of the world. And there's a reason that certain countries are good at manufacturing or creating certain types of goods. And we begin to transition towards a idea of globalization, which I'll go into more detail about that. But what I want to impress upon you, at least for this short time, is really how intertwined we are as economies. What has an effect on one area of the world has a drastic effect on the other. We've all seen what's been happening recently with the European debt crisis and how that has impacted the U.S. in the form of just the stock market and all these other things. And so to think that we live in isolationism as we once did back in the 19th century is a little naive. A lot of things that happen in one area of the world have a direct impact on what happens here. So let's talk about this idea of globalization here. Really, what is globalization? Well, globalization is the process by which a world economy becomes a single, highly interdependent system. Essentially, that's the meshing of economies. We're essentially losing our individuality, so to speak, and we're coming together and instead of all these individual economies for each individual nation, we're now becoming one actual economy. There was $12 trillion that were actually traded in merchandise last year. And that's a significant amount of money, $12 trillion. The foreign investment, so foreign companies, invested about $150 billion in the U.S. And the U.S. invested approximately $30 billion in other countries around the world. So as you can see, there's a significant investment both by the U.S. and some of these other areas of the world, because obviously we can't produce everything that we need to be sustainable. And also these other countries beginning to invest in the U.S. because they can't get certain products in other places. And so that's really this idea here. Now, globalization takes place through a process of exporting and importing. When I say exporting, what I mean is that we are manufacturing something domestically, and then we are shipping it overseas to be sold. So for example, in the U.S., if we manufacture certain automobiles and then we ship those overseas to sell in Europe, that would be an example of exporting, because they're not produced overseas, they're produced domestically in the U.S., and we ship them overseas for sale. Now, importing is the exact opposite of exporting. With regards to importing, what you're doing is we're actually bringing products in domestically. So if we have certain products that are manufactured overseas, for example, Japanese automobiles manufactured by Honda, Toyota, those types of things in Japan, they in turn ship these over to the U.S. for sale. That's an example of an import, because we are bringing them into a domestic market, but they are not being manufactured in that domestic market. Now, in order to help economists and really international traders kind of differentiate between certain areas, they have different categories that they put countries in. And really the reason that they do this is to get a better idea of where my products would be better suited for. So we have four primary distinctions that we provide to countries based upon wealth. And like I said, the reason that we want to differentiate based upon wealth is if I have a certain luxury type good, I want to know what is the best market for my product. I wouldn't want to necessarily market my product in the Sudan if I'm designing luxury handbags, because if you're earning $200 to $300 a year, you're not going to be able to afford my product. It's something that you don't need. It's a luxury item. As a result, I need to market it in a place that has some type of disposable income. So I want to know where are your high-income countries. Okay, an example of a high-income country, the actual bracket they provide is a country where annual per capita income is greater than $11,115 per year. So annual per capita income, per capita meaning per person. Okay, so you take the basically GDP and divide it by the number of people in that particular economy, and that is your annual per capita income. You have upper middle income countries. Upper middle income countries earn less than $11,115 per person and greater than $3,595 per person. Next, you have lower middle income countries, which are less than $3,595 and greater than $905. And lastly, you have your low-income countries, which are considered to be developing countries, and those earn $905 or less annually per capita, so per person. And so like I was saying before, if you want to determine if there's a market for your product, depending upon it's a luxury good or if it's considered to be a necessity, you want to know what is the wealth of the country that I want to go into. A lot of companies like toothpaste manufacturers like Colgate wanted to penetrate these low-income countries, and what they found was their products were too expensive. So they started to manufacture those in smaller amounts, almost like travel sizes that we actually have here. And they sold those in some of these lower income areas because people could now buy them. It wasn't such a significant purchase to them because it was a very small thing. Now, obviously it didn't last very long, of course, but in terms of how much I can spend at a moment in time, it was feasible for me in those particular countries. Now next, businesses also want to differentiate based upon geographics. This would make sense because there are certain value systems, certain cultures, certain differences based upon where a country is located geographically. You also deal with issues with certain climates and different things. So where one country may use a certain type of product, another may not have a particular need for it, right? So they're grouped in three primary clusters. First, you have North America. North America consists of the U.S., also consists of Canada and Mexico. Those are the North America, those constitute the North American geographic cluster. The U.S. obviously being the dominant player of the North American market, although Canada is a primary player. The U.S. does its predominant amount of its trading with Canada and vice versa. Next, you have Europe. Europe consists of, I believe, at least at this point, about 17 countries. They're a part of what's known now as the European Union. And those are, you really cluster them in two areas. There's Western and there's Eastern Europe for the most part. That's usually how you consider them. But once again, this is designed to determine what are the value systems, what's the culture like of those particular areas. Although you have individuality in terms of the nations, it's a lot easier to group them as one particular area in terms of doing business with because they're more similar to one another than if you were to pair a North American country with a European country. And last, you have the Pacific Asia here. Pacific Asia consists of Japan, China, Thailand, Taiwan, Philippines, to name a few. China obviously being densely populated now, you're seeing China as a huge opportunity for a lot of countries. A lot of companies, even companies like Google, for example, who at one point in time decided that, I really don't want to do business in China because of all the political legal reasons, right? We don't believe in censoring our search results like they want us to because they have state-controlled media. But at that point in time, they left, but now they're getting to the point to where, we really have to figure out a way to do business in China. When you have the amount of people they have in a country, there is no way that you cannot do business in China and continue to be successful. So a lot of companies are beginning to transition towards working with China despite some of the issues in working with the government because they see the opportunity there. They see just the raw data. The number of people is a huge opportunity regardless if maybe it's a kind of a lower middle income country. Now, one thing I wanted to mention here real quick before I go into some of the trade agreements and alliances is I did a little bit kind of brush over globalization in terms of the reasons for it. You've probably seen a lot of people that have been adamantly opposed to globalization, and some people are proponents of it and maybe not know why. So let me give you kind of a brief run through of some of the primary reasons that critics and proponents argue with regards to globalization here. So in terms of the benefits of globalization, at least the perceived or supposed benefits, the first of which is a higher standard of living. And the argument is that you're bringing jobs to certain areas. So if I have an area of the world like China, for example, and they're just isolated by themselves, they don't have a great deal of opportunity to earn income. But if we have a U.S. company who then obviously starts a manufacturing facility in China, then they're bringing jobs to that region. They're allowing them to work for maybe more money than they originally did. Now, a lot of times that fails in comparison to what we would earn in the U.S., which is where U.S. companies get a lot of flack for. But still, a lot of times it's better than what they were earning if they had had a job domestically. Okay. Next thing is it improves business profitability. And what I mean by profitability is we know profitability from earlier in this particular in past lectures, that profitability is determined by taking the revenue, so what you sell something for, minus the expenses or the costs, what you have to pay, what's your outflow. And so if I reduce my expenses by locating in some countries that are considered to be maybe cheaper labor force, then that increases the extent to which I am profitable. So that's another advantage. Another reason why globalization has increased in terms of the rise or prominence of it is because of technology. A lot of times it wasn't feasible to do business in various parts of the world because the technology didn't really support it. But now we have a number of different things. We have international travel. We have communications where we can actually video conference with people around the world. Commerce has got a lot easier now. Some countries and some areas of the world even develop a consistent currency, like the European Union with the euro, where all of the nations actually trade that particular currency. Another reason for the rise and support for globalization is just the increased competition. A lot of countries are pursued or encouraged to operate internationally because of the fact that everyone else is really doing it. And it sounds like a pretty lame excuse because it's kind of peer pressure, but at the same point in time, I really don't have a choice, right? If all the other companies that are in my industry are going international, then I am going to be left in the dust if I don't. And so that you have that working with you as well. Now, there obviously are some disadvantages to globalization, or at least some perceived or supposed disadvantages that are claimed by critics. The prominent one, and the one that you'll always hear, is that it eliminates jobs. We're actually shipping jobs to other parts of the world, right? We're shipping manufacturing jobs to Mexico, China. We're shipping call center jobs to places like India and other areas of the world. We're shipping software jobs to places like Ireland. We're shipping jobs to these places where people will work for less. And so it's difficult for U.S. workers to compete with that because obviously there's a certain standard of living here that we need to attain or need to aspire to if we're going to live comfortably. Now, what a lot of proponents of globalization say is that although it does reduce certain types of jobs, like your lower level, not very skilled manufacturing type jobs, you do create other opportunities when globalization results. Typically higher level jobs requiring a little more skilled workforce, a more educated workforce. So that's kind of the counter argument there. Another issue that most people have, and you've seen a lot of different consumer advocacy groups develop around this, is how big U.S. companies exploit some of the small defenseless workers that are in some of these other countries. And I don't mean small from a standpoint of height, I mean small in a standpoint of power. And that's something to be considered, obviously, right? If you're held to one standard in one country, is it ethical to actually operate differently in another? Legally, you're fine, right? You have not breaking any laws. But is it ethical when you know what working conditions like are the U.S. and to subject something to maybe a lesser working condition overseas? Maybe, maybe not. Right? We dealt with ethics before previously. And so depending on your stance on that, you may feel differently. But a lot of companies have been under increased pressure to actually produce supplier lists and different manufacturing facilities that they use for inspection because we want to make sure that are they operating ethically? Are they keeping their same principles and same interests that they do in the U.S. when operating in some of these other areas of the world? The last disadvantage that I'll go over for globalization is a perceived loss of cultural heritage. As we mentioned before, with the process of intertwining of the economies, what happens is our cultural heritage begins to get lost, or at least that's the argument, meaning that I can now purchase things that are manufactured in other areas, right? We're becoming very similar to one another. We listen to similar music. We dress similarly because now we have media that is accessible all different areas of the world. Technology has increased the prevalence of my ability to watch shows that are manufactured or produced overseas, and to buy clothing because I see them in this television show that's now internationally. And so we begin to look more similar to one another in terms of dress and appearance and those types of things. And so that's a potential argument there, is by manufacturing products that we're making in, let's say, Japan, and now selling them everywhere else, we're beginning to look more similar to one another. We're beginning to lose our heritage because it's all becoming spread out. It's becoming kind of like a melting pot, which is how the U.S. was described back in the early 20th century to late 19th century with all the immigrants that came into the U.S. in that particular time period. Okay, I digress there. Let me go over some of the trade agreements and trade alliances here. Now, the purpose of a trade agreement and a trade alliance is basically to make two countries or two or more countries agree on how they're going to do business. The idea is that we would encourage free trade. We would reduce these different barriers and things that I'm going to introduce you to later on, and trade with one another and improve the economic sustainability of our countries. So there's three primary trade agreements that you need to be familiar with. The first is what's called NAFTA, the North American Free Trade Agreement. As we know, North American continent here constitutes Canada, Mexico, and the U.S., and those are the countries that have agreed to NAFTA, so to speak. And what NAFTA does is it reduces or removes a majority of the trade barriers between Canada, Mexico, and the U.S. The idea is that now we wouldn't have as many tariffs and quotas and things preventing industries like in Mexico, for example, for shipping to the U.S. Same thing with the EU, the European Union, which I believe is about 17 member nations as part of the EU. The EU actually went a step further. Not only do they want to reduce the actual tariffs and quotas and things, they wanted to reduce those trade barriers, but they actually adopted a single currency back in 2002 called the euro. And the euro is like the US dollar. It's the form of currency that they use. So instead of having 17 different currencies from all of the nations in Europe that are a part of the EU, they have one currency, which makes it a lot easier to do business, right? Because you don't have to calculate the exchange rate, and the exchange rate, which we'll go over later on, always changes. And so now, well, it's not a favorable day. The dollar is worth, or my particular currency is worth less, so now it doesn't go as far. Maybe I'll hold off. You don't have those issues anymore because everybody is using the same exact currency. One of the problems that we've had here with the European debt crisis with obviously Spain, Italy, Greece, and it's kind of spreading to some of the other countries, some of the larger countries, and you've seen that their actual credit ratings by S&P and Moody's and those different institutions has been downgraded, is that's affected people's confidence in the euro. So at one point in time there was a little bit of fear, is the euro eventually going to fail? And if that's the case, I obviously don't want to own a lot of them, right? I mean, that doesn't make a lot of sense. It's like owning an Iraqi dinar. The currency doesn't exist anymore. And although you can hold it, it's tangible, that's great, you can't purchase anything with it, right? There's no significance. There's no value to it. So as a result of the fear that the euro was eventually not going to be there, a lot of people begin to not purchase euros. They didn't want to hold on to them because there was this fear that it may not be worth anything later on, which in turn caused the value of the euro to decrease in relation to other currencies like the US dollar, for example. All right, now the Association for Southeast Asian Southeast Asian Nations, acronym obviously ASEAN, consists of obviously a lot of the Southeast Asian countries. Same type of thing. It's designed to be very similar to NAFTA in the EU to reduce trade barriers in the area so that we can now trade more freely and not have to pay different taxes and things for shipping our products overseas. It isn't as powerful as the NAFTA and EU, has less global significance, because if you look at some of these nations and if you were to compare them to the different examples that I gave you of distinguishing between countries based upon wealth, a lot of these countries are not going to be in your high income, even your upper middle income area, which is why it has less global significance than the EU and NAFTA as well. All right, another significant treaty here. We talked about agreements. These are now treaties. Is the GATT, which is the General Agreement on Tariffs and Trade. The GATT was signed in 1947 in response to World War II. And the reason for that is because a lot of the people that, or the dictators like Stalin and Hitler that people turned to because they were just in such economic strife that they really had nothing else to go to. And that almost appealed to them, so to speak, because that they were able to articulate this vision, right? They were leaders, regardless of if their cause was good or bad, they were leaders. They were able to articulate this vision of what life would be like if we were to eliminate some of these other countries that were oppressing us. And so in response to that, in response to, the idea that when people are economically disenfranchised, they tend to turn to something they don't quite understand. They developed the General Agreement on Tariffs and Trade to reduce these trade barriers with some of these countries so that they can now start to produce something and bring in some type of income. And so that was the intent there. By reducing or eliminating trade barriers, we would give or provide economic prosperity to these certain areas of the world. Now, the GATT later on created what's known as the World Trade Organization, commonly referred to as the WTO. WTO was created in 1995 and has 152 member countries, at least to date here. And the idea is that they would open those markets to international trade. Once again, we want to reduce as many barriers as we can because we want to promote the economic sustainability of some other countries. Okay? And the WTO has three primary goals. Okay? The first thing is going to promote trade by encouraging members to adopt fair trading practices. Unfair trading practices being cartels and dumping, which we'll go over later on in the lecture. Two, the goal of the WTO is to reduce trade barriers by promoting multilateral negotiations. We want to promote countries talking and speaking with one another to develop some type of agreement on what to do with barriers. Okay? When one country typically enacts a barrier, a lot of countries enact their own barriers in retaliation. And so we don't want that to happen. Three, WTO also establishes fair procedures for resolving disputes. Okay, so if there's an issue between two countries, there is a procedure set up on how to deal with that particular dispute. And so those are some of the goals of the WTO. That's essentially what it does. All right, let's look at international trade here. International trade, just so you know, it takes place when an exchange occurs across national borders. So that's an example of international trade, an exchange occurring across borders. Now, there's a couple of key terms here you need to be familiar with to understand this concept of international trade. The first of which is known as a balance of trade. And when I say balance of trade, what I mean is the economic value, right? So the dollar value, if it's in a US dollar, of the products that a country exports minus the economic value of all the products that a country imports. Okay? The reason that we want to know what the balance of trade is we want to know, are we spending more money than we're taking in, right? If I export, that's like revenue. That's money that's coming into the US. If I export, that is money that's leaving, right? I'm sorry, vice versa. I'm confused, okay? If you export, right, what are we doing? We're shipping something overseas. We're selling that. If we import, we're buying something and bringing it back. So if I export more than I import, my balance of trade becomes negative, meaning that more money is leaving the U.S. than is actually coming in, which is not very good, okay? We all know that if you spend more than you make in a year, that's not a good thing. And either is that for a balance of trade. Now what happens is, if that continues, you develop what's called a trade surplus or a trade deficit. And a trade surplus is when you have a positive balance of trade, right? When we export more than we import. That's considered to be generally a positive thing because we're bringing in more money that we can use towards other things. A trade deficit is when you're obviously importing more than you're exporting. The U.S. is consistently known for increasing its trade deficit consistently because we rely on some of these other things. We love products. We love to buy things from all areas of the world. Not only our dependency on foreign oil, but we have a lot of dependency on some of these other things. And so we rely on those because we don't produce a great deal domestically. as much as these other countries do. And because we can't produce everything that we need, we have to get it from somewhere. The only problem, though, is we're not exporting enough to counteract that, which results in that trade deficit. Now, the reason that those two things are important is because they have an effect on the balance of payments. A balance of payments is that flow of money into or out of the country. Not only does it consist of the balance of trade, but it also consists of, people that go on vacations in other areas, right? If I, who live in the U.S., go on vacation in Europe and spend a bunch of money, that affects the balance of payments because that's my money now going into the European economy, and it's going out of the U.S. economy, right? Same type of thing as when you have people from overseas vacationing in the U.S., that changes the balance of payments. So not only are we considering what the exporting, what the importing is from the actual goods and services, but we're also considering what people do with their money, vacationing. If the U.S. sends some type of financial aid over to a impoverished area of the world, that's money that's leaving the U.S. and going to that other country. That would factor into this balance of payments. And the reason this is important is because we want to know where the money is going, right? That's kind of like in a business company standpoint, you want to have a statement of cash flows. You want to understand where it's going and why, so that if it's something that we don't like, we can possibly change something about it. All right, now let's go into a little bit about exchange rates. An exchange rate is a rate that you can exchange one currency for another nation's currency. So the US dollar, for example, if you were to try to exchange that for a euro, one US dollar would get you roughly, I believe, 0.75 euros. So not as much, right? Your money is worth less in the denomination of an actual euro. Now, there were two primary exchange rates that were developed, and one is more common than the other now. The first of which is a fixed exchange rate. And what that means is that the rate of exchange for one currency to another is fixed. It does not change. So for our example, if we had a fixed exchange rate, $1 would always be worth 0.75 euros. Okay? Now, we don't have a fixed exchange rate anymore because it's very difficult to manage the flow of money in and out of a country, which is that balance of payments that we were talking about. So now we have what are called floating exchange rates. Okay? And a floating exchange rate involves the value of one nation's currency changing or fluctuating in terms of value to that currency of another. If you want to get a good indication of this, just pull up any type of marketing dashboard or finance dashboard, either Yahoo Finance, Google Finance. Wall Street Journal has a really good Market Watch actual financial section there, and you can look and you can view the value of currencies changing pretty continuously, pretty frequently. Okay? And that's because they change based upon the balance of payments. If more money flows into one particular country and flows out of another, what that does is that causes a nation's currency to rise, which is what we'll get into on this next slide here. Okay? So, a nation's currency becomes strong. Let me give you an example first off of how this plays out practically. Certain areas of the world were becoming very, very let's say, upset with the U.S. because the U.S., whenever we want to inject money into the money supply, into circulation, right, with the mentality that if we have more money available, people are going to spend that, what that does is that raises the level of money available. Okay? Now, what happens is because there's more money available, it is now worth less. Okay? And so if I'm holding currency, if I'm China, for example, who is the second largest holder of U.S. dollars, my money that I'm holding now is now worth less. When there was an issue with the euro was decreasing in value significantly. It got to, I believe, $1.25 for basically $1 in the U.S. dollar, meaning that $1.25 or 1.25 euros would get you $1 in the U.S., which wasn't like it always was. It was when they introduced the euro back in 2002, 1 euro got you $1 US. That isn't the case anymore because they're a floating exchange rate. But what happened was, so as the European debt crisis began to unfold, as I mentioned before at the beginning of the hour here, the value of the euro compared to other countries began to decrease significantly because the fear is that that country was, or that basically a trade agreement, so to speak, that collection of countries was to begin to deteriorate, and then they may have to eventually break off into separate countries, thus resorting back to their original currencies, thus making the euro essentially worthless. So that currency began to decrease because people did not want to hold it for fear of that. What that did was that weakened the euro in comparison to other currencies. So more specifically, Switzerland, for example, begin to get a little frustrated with that because that affects their ability to do business. Because if I'm a domestic company, if I'm Switzerland and I'm trying to export goods into the European Union, into the EU, it's now more expensive for citizens of the EU to buy my products, even though on paper it's really the same, right? I'm still charging you 20 of my currency to purchase this, but your currency doesn't go as far. So what happens is if you have one economy's currency get stronger, in this case Switzerland's economy was getting stronger in comparison to the EU because the EU was faltering, that made it harder for their companies to compete because their goods were now more expensive. They were now not as easily attainable, so to speak. My money did not go as far. And so that's one issue that results when we have different currencies obviously increasing in strength and then decreasing in strength. Foreign companies find it easier to import products, right? That's very, very easy to do. Let's say, for example, if I'm Switzerland, well, now I can go to the EU and my currency, which was now, considered to be, let's say, 3 to 150, is now 3 to 125. So it now goes further. So now I can go in, I can import more products, I can buy more things because my money goes further than it originally did. Even though that price tag on the products is still the same, the exchange rate is more favorable to me. Now what will eventually happen is if a country's currency continues to be strong is that you're going to have domestic countries or domestic companies are going to move their production sites over to some of these cheaper areas. Because they really just can't compete because it's difficult to manufacture everything in one currency. When you're spending it, it's much stronger, and then trying to sell things for much less in another area of the world. So those are some of the implications with regards to the issues in currency. Obviously most countries want their currencies to remain fairly stable. They don't want them to increase significantly, and they don't want them to decrease very significantly because that has a drastic effect on their businesses' ability to do business with some of these areas of the world. Now let's look at when a currency is weak. So let's say we take the example of we're the EU, for example, and our currency has decreased, the euro has continued to decrease, and now we're doing business with some of these areas of the world. In terms of my domestic companies that are in Europe, for example, we have a more easy time exporting our products. And the reason for that, remember, is that just like Switzerland had an easy time importing those products, we're going to have an easy time exporting them because our currency is now weak. People can buy more of our currency. Okay, so just take for example, if the U.S. predominantly trades with Canada, or let's use Mexico for an example here. The U.S. trades a lot with Mexico, right? With NAFTA, we've opened up our trade borders and made it more easy to do those types of things. A lot of manufacturing facilities are in Mexico. Obviously it's not very far in terms of geographic, so it kind of makes sense. They have a relatively low-cost labor force. If the U.S. dollar decreases in terms of its relativity to the peso, which is used in Mexico, the U.S. economy, the U.S. dollar is considered to be weakening. Okay, so that currency is getting weaker. Now what that does domestically is I can now export more products to Mexico because Mexican citizens now are taking advantage of a favorable exchange rate. That peso, maybe it was $1 would equal 0.5 pesos. I'm not sure on the exchange rate, but it's an example. Well, now say my dollar goes to 1 peso. And so now instead of me in Mexico having to pay 2 pesos to get $1, it's now 1 to 1. So I can now technically buy twice as many goods as I normally did and still spend the same amount of money because the exchange rate is very favorable. Now likewise though, for Mexico specifically, it's now more difficult for my foreign countries, so my Mexican countries in Mexico, right? It's now harder for us to import products to the U.S. because the U.S. citizens are now looking, well, I have to pay twice as much for this technically, and really it's not worth it to me. And so those are the same issues, right? So what benefits one is as a result of the detriment to the other one, which can be somewhat of an issue. All right, I'm going to stop there for this part here. Feel free and do check back with us. There's going to be a second part, a continuation of the international business information that we're going over, so do check back, but I do want to split these up into about 30-minute time blocks to make them more manageable. So thank you for being with us here. Thank you for joining, and do check back for part 2.